All right, joining me now here on the Matthew Filipowicz Show is Sam Gindin. Sam is the former research director for the Canadian Auto Workers Union. He is a professor at York University in Toronto. He is the author of several books, including his latest, The Making of Global Capitalism, The Political Economy of the American Empire. Sam, thank you so much for being on the show.
Great to be here.
All right, so Sam, you recently wrote a really interesting article for the magazine Jacobin about how the left should assess the economic crash of 2008. Let's begin with, what do you think some of the mistakes are that the left is making when looking at the crash?
Well, I think a general mistake that's very important to address is the notion that there's always the same reason for the crash, that there's a monocause explanation, either that capitalism has a tendency for the rate of profit to fall, or the crash is because of overaccumulation. And I think the first really important thing is to understand that capitalism is a system that develops historically. And when we talk about crashes, there's only been, about 4 crashes since the 19th century, 4 major structural crashes. We're not talking about the ups and downs. And as soon as you have one of these things, what's happening is that capitalism comes up across certain barriers. They might be institutional, they might be the balance of social forces in society, and then it's not clear whether they can overcome it or not. It's a contingent question. In the middle of these major crises like the Depression, nobody knows whether you're going to come out of it. But once you come out of it, if you do, and so far they have, everything changes because they change institutions. They change the balance of class forces. And what that means is the next crisis is different than the previous one. You have to take all of that into consideration. So in this particular crisis, unlike the 70s when the working class was strong, in this particular crisis it was weak. Unlike the 70s when there was a concern about inflation, now there isn't a concern about inflation. Unlike the 70s when there was a concern about the dollar, now it's clear that the dollar is dominant. People come to it into the United States even when the crisis hits the U.S. And there's the role of finance, which leads to another problem, which is that people see finance as only speculative. They don't see it as part of the real economy. And of course it's speculative. Of course there's all kinds of crazy, wild things going on with finance. But it's, one of the criticisms of capitalism is that it actually needs this kind of a finance to function. And one of the contradictions that's emerging out of the crisis is that business doesn't want the volatility that we're seeing right now, and yet they want the kind of a system, a financial system, that's liberalized because they get benefits from it, that inevitably leads to that kind of volatility. So getting a grip on finance and understanding the special role that finance played, although it's all integrated into the overall system, is also very important.
So how do you think the left should approach the last crash? What is the approach that we should do when trying to educate others on this, and how to actually make people understand exactly what went down?
Well, one thing we shouldn't do, and I should have added, is there's a tendency to think in terms of the U.S. being in decline, and that leads to a certain kind of politics. It's like waiting for the U.S. to collapse, and that'll solve our problems. So what we have to recognize is this may be a horrible moment for workers, the unemployed, young people looking for a job. It's not a horrible movement for capital. Capital is restructuring and doing very well. And part of the reason they're doing so well is that we're so weak. The real crisis we need to talk about is the crisis in labor, because they can just solve these things on our back. Now, in terms of thinking about what's essential for understanding the crisis, one of the key things is recognizing how finance has changed and the role that finance plays in the economy. You can't understand this crisis without the special role of finance, and that means seeing that even though corporate profits have risen so much, and you think that, well, if they're making so much profit, what do they need finance for? They don't have to borrow money. Finance has actually become more important because the banking system, investment houses, first of all, they shifted a lot to lending to consumers. So a lot of their money is coming from, the profits are coming from consumers. So workers as consumers have become very integrated into capitalism. They provide services to business, not just loans. That can be ranging from venture capital, which doesn't involve credit, mergers, but especially what's happened is that in order to have a global capitalist system, you have to have some way of dealing with the risks of exchange rates and inflation rates and political risks abroad, because otherwise it slows down how much you're going to go abroad. It's like not having a decent financial system. Transportation system is a barrier. And finance has, through derivatives, through these deep financial markets, developed mechanisms, not always consciously, but it's developed these mechanisms so that capital can hedge its bets, hedge its risks, and therefore continue with globalization. Now, that's brought new kinds of uncertainties, obviously, and new kinds of risks, but it's been absolutely fundamental to the system. It's been fundamental to the U.S. in terms of attracting capital, so it can maintain its economy even as foreign direct investment is going abroad. It imposes discipline on everybody, which restructures the economy in terms of moving capital around, threatening workers if they don't give in. So finance plays an incredibly important role, and what's happened with finance is that on the one hand, it's extended the boundaries of risks. In order to get high profits when interest rates are so low, it's moved into sectors that are more risky, including the subprime mortgages. That's one of the things it's done. The other thing it's done is it's increased its leverage, which basically means you take a certain amount of assets or cash and you put out more loans on that, which also increases risks. So you have a system that is very vulnerable, and workers themselves, because they're depending on their homes as an asset now, this has become a major thing, and because they're in debt, and because when something interrupts that flow of debt, since their income isn't rising, they get into trouble, and this has a major effect on the economy because it's not just like the stock market. If housing goes down, you've got construction, and you've got workers pulling in their spending because now they're worried about their future. So you've got this structure of the economy with finance playing this incredible role that is very vulnerable to any kind of interruption. And when that interruption came, it really escalated. And once that happens, you have a new kind of problem, which is how do you get out of it? And the point is that finance has a lot of power, and it doesn't want to see you getting out of it just by stimulating the economy because they're worried that this may create inflation, which will devalue their assets. In other countries, not so much United States, they're worried that if you keep stimulating the economy and borrowing more, you may not be able to pay it back, which would mean the banks would be at a greater risk. So banks have very much favored austerity. They're very much in favor of austerity. They want the economy to recover, but they're very much in favor of austerity. And so on the one hand, we've given the banks enormous funds to stabilize them on the basis of stabilizing the banking system because we're so dependent on it. It's critical. But we've been reluctant, and when I say we, I mean states have been reluctant to really regulate them because they feel like if they really regulate them too much, they will kill, the golden egg, because they need finance. They need finance to play this role, and yet it means these kinds of risks. So there's this reluctance to take on finance and really stimulate the economy, which to get some kind of stable growth going is going to have to mean increases in infrastructure. Otherwise, we're sitting around waiting to see whether corporations who are rolling in dough decide that either for competitive reasons or because they actually think there's a bit of an upturn, they're going to start investing, which will hire people and get the economy going again. But even then, I think it would likely be relatively slow growth unless there's a much more dramatic move to increase infrastructure.